Years, almost to the day, I was an intern at LIFFE, the London International Futures Exchange, sitting in a seat like that somewhere, trying to figure out what to do with my life, literally. And it was a great experience. I was between college and grad school, and it was, one of my first real exposures to the marketplace. To give you an idea of how different it was at the time, part of my group's functions was to go in on the weekends, figure out how to move the pits around, because we had so many people blossoming out of the pits that we had no room for them. So we'd spend a lot of time figuring out the mechanics of it. Obviously very different today. And it occurred to me as I was talking to John about what to talk about, how much has changed over the last 20 years. It's been an incredible amount of market structure change. I'm going to try to do it all in 10 minutes, which means I get 30 seconds per year. First date I'm going to give you, August 9th, 1995, Netscape goes public. This was a dramatic thing for the industry, both from the perspective of the investing public and technology in and of itself. There's always a tight bind between technology and the financial services industry. This is one of the starkest examples. Netscape goes public at $28. By the end of the year, it's $174. Everybody's interested in the equities market. At the same time, technology, because of firms like Netscape, is enabling people to trade not just through their brokers, but directly with marketplaces. This has a dramatic effect. I have a clip I wanted to try to give you some demonstration of it. Before the E-Trade baby, before the Schwab, those strange commercials with talking cartoons, was Stewart. And I want to see if I can, and here we go.
Stewart, can I see you in my office, please?
That kid is sick. That hinge is squeaky. He's very sick.
Stewart, get in here.
Sure thing, Mr. P.
Stewart, I just opened my Ameritrade account.
Let's light this candle. Let's go to Ameritrade.com. It's easier than falling in love. What do you feel like buying today, Mr. P?
Kmart.
So research it. All this stuff is provided for you free of charge.
No cost.
Yeah, that's synonymous with free.
Looks like a good stock.
Let's buy.
Let's buy 100 shares.
All right, click it in there.
Okay.
How about 500?
100, Stewart.
You feel the excitement? You're about to buy a stock
Okay.
online.
Oh! Fabulous. I'm thrilled. What did that cost me?
$8, my man.
Mike Broker charges me $200 for this
Riding
trade.
the wave of the future, my man. I gotta get a soda.
All right.
I'm sorry, Mr.
Wait a
P.
minute.
I'm having a party on Saturday night if you really want to go.
I'm going to try and get there. Thank you, Stewart.
trading.
Thank you.
Rock on.
All right, Stewart.
Ameritrade. Believe in yourself.
All right, two things I want to point out there. One is, two amazing things. One is that a trade could cost $200, number one. Number two, it's now occurring to me that I'm far closer to the older guy's age than Stewart, which is a little disturbing for me. So, but really what this represented, and this was a remarkable change. You could trade directly with the marketplace. You could do it at $8 a share. You were enabled by technology. What did this do? It increased volume tremendously. Over the course of the next, from 94 to 2000, we saw volume increase at a rate of 35% annually. Tremendous. I mean, the industry had never seen anything like it. It was bound to drive change. At the same time, remember I mentioned to you earlier that I was working at LIFFE. In around 1998, there was something called the Battle of the Bund. And what happened there was LIFFE had always traded the Bund contract for many, many years. The volume had been split about 80-20. Well, right about 1998, something changed, and it fundamentally changed because Deutsche Börse, its predecessor, was trading all electronically. And I'd actually sat in one of these meetings just like this where Deutsche Börse had come in, talked about how electronic trading was going to change everything, and everybody laughed. Well, ultimately it did. There were a lot of other inputs into that, but ultimately it flipped. And not only did it flipped dramatically. More than almost 100% of the Bund contract ultimately ended up trading at Deutsche Börse. LIFFE got out of that business and ultimately shut down the floors. This sent shivers across Wall and LaSalle Street and gave rise to people like Terry Duffy, who ultimately had to come in and change the direction of organizations like the CME. When you talk about what would have happened, that was the type of episode that could have occurred, and it was dramatic. Back in the States, what was going on here was as this volume was increasing, you saw firms like Archipelago, Instinet, Island. They start to pop up and trade NASDAQ stocks. And when that occurred, right around that time frame with all that volume, you had all these people who wanted to trade electronically. They didn't want to go through a broker. They didn't want to go through a specialist. They want to come directly into the marketplace. They wanted immediacy, and they want quality executions. And that's what they were looking for with these all electronic markets. So you saw the NASDAQ volume break. You saw its volume start to shift from NASDAQ proper to all these other competitors. Well, what happened after that? 20% of the volume, or the market cap, is trading on NASDAQ. 80% is over at the New York Stock Exchange. That's where all the action is. That's where everyone wants to be. The New York Stock Exchange is still a manual, specialist-driven model. It's electronic to access the exchange, but when it gets there, specialist who is the sole holder of that order, of anything trading in that symbol, gets to look at it, gets to decide what to do with it, ultimately decides whether they want to provide liquidity to it or not. Now, there's certainly obligations that they have, and I don't want to minimize that, different than the pure electronic model. But it was vastly different than what we were seeing on the NASDAQ side. This gave birth to Reg NMS. And you hear a lot about Reg NMS, and it gets, there's a lot of negative press about it when we get to today's world, and I'll get to that. But at the time, it was trying to bring fairness to the marketplace, bringing everyone on an equal playing field, and ultimately enhancing the experience for the individual investor. What happened? Well, Reg NMS was really, at its core, a way to break the New York Stock Exchange's monopoly. And it did. I mean, to that end, it worked. If you look at January 2003, when a lot of this was being discussed, and over the course of this period, you start to see the specialist investigations. There's certain scandals that start to pop up. Becomes a focus of the media, becomes a focus of the regulators. They passed Reg NMS in January 2005. New York Stock Exchange is at 80% market share. By the time it's implemented, they're down to a little over 50, and within about a year, they're down to 20, 25. Pretty remarkable. New York Stock Exchange had been the home for New York listed stocks since its founding. And all of a sudden, they're now at 20% market share. Dramatic. So in the midst of all that, there's there's $50 billion plus worth of exchange M&A as exchanges are trying to figure out how do they navigate this new world. Scale, efficiency, all of that matters. And for the first time in January 2003, I hear the term, and maybe a little earlier, but I hear the term high-frequency trader. I'd never heard that before. I knew specialists, I knew market makers, I knew liquidity providers, but that was a new concept. And where did they come from? Well, out of the automation that we talked about earlier in that prior generation, you had individuals trading upstairs, but they tended to be former traders off the floor, or just people who wanted to get into trading but wanted to access it geographically from a distant locale. That changed as firms became more institutionalized and were dominated more and more by technologists. People like Don, people and others who were really innovators in the industry. They, working along with their exchange partners, started to dominate the liquidity environment. And that happens over time, and you see it really from, if you think about where the volume and the market share came from, that was obviously going from the more floor-based models to the off-floor environment. This continues through the financial crisis. So what happens? You take a look at 2005, you see high-frequency trading at about 20% market share. By the time 2008 rolls around, they're over 50 and growing. They came out of the financial crisis because of how they risk managed and how they approached the marketplace fine. You know, they weren't carrying overnight positions in the same way and inventory in the same way the banks were. They certainly weren't trading in the over-the-counter markets where they were exposed to counterparty risk in the way the banks were trading. And frankly, a lot of them were based in Chicago who had a risk management profile and view of the world that was just different than those who didn't come from a proprietary trading environment. So you see them grab market share. They're up over 60%. You see, obviously, profitability alongside that. But something happens, as it always does in any industry, especially any industry that is as technology and infrastructure driven as the trading space, is it starts to attract competitors. And on top of that, you saw volume declines that made it more and more competitive. Every share traded every dollar per share started to come down. You see more new entrants, as any good free market should attract. You started to see high-frequency trading profitability take a hit. That's okay. That's what's supposed to happen. It's a sign of healthy markets. Now, of course, over this time frame, all sorts of things are happening, right? There's flash crash, there's outages, there's general dissatisfaction with the financial services industry overall. Initially, the proprietary trading community kind of came through that okay. As some of these outages occurred and some of these problems associated with the integrity of the marketplaces popped up, you obviously saw more and more attention. And this leads me more to where we are today. I thought a lot about, many of you I'm sure have read Michael Lewis's book. You read what is published in the press. I'm a third generation participant in the securities industry. I care very deeply about the quality of markets and the state of capital formation. So it's very hard for me to reconcile. On the one hand, you hear people say, oh, the markets are rigged. And then on the other hand, you hear people say they're the best they've ever been. And how do you reconcile? I thought a lot about that and what do you do with it. And certainly if I'm in your shoes, I'm thinking about that pretty seriously because I'm trying to figure out what to do with my career. So I've tried to explain it, at least, or at least in my own mind, try to get to a place where I can reconcile the two. I think one of the issues is you have so many different participants required to create a robust capital markets. You cannot have a capital market system without exchanges, those willing to stand up and provide liquidity, investors, and issuers in whatever form. You can't. And each one of them is going to have their own distinct needs to be able to participate and function, not to mention that each one of them is going to be competing fiercely at each level, as they should. You want fair and transparent markets. You want quality execution. You want deep liquidity. You want to protect investors. And ultimately, you want to create a robust environment for capital formation. These are the things that are signs of a healthy capital markets. And I think when people say we have the greatest capital markets in the world, I think we have the best of this side and this side. On top of all of it, of course, you have regulators, you have the press, and you have public's perception. All very important pieces. So you have all these dynamics playing through, and every time we have one of these, a single point, so someone will bring up something like high-frequency trading or co-location or best execution, and you're really talking about one piece, but some of these, like any two goods, not all goods, two goods will conflict at times, and you have to arbitrate the two, and I think that's what you hear a lot about within the industry. How do we arbitrate all of these goals? And I think that's the critical piece in all this is, again, as I think about your careers, I don't know. I don't know what the future holds. I know that if you'd asked me 20 years ago, I probably would have said the exchange with the most space wins. And look where we are, right? I think today, similarly, I don't know where we're headed. I know this is the most dynamic industry out there. I think it changes. I think the creative renewal in this industry is like none other. I'm also very, very positive. John, you talked about our recruiting process and our corporate environment. I am incredibly optimistic about the people coming into this business. I know what it takes for us to go recruit all of you. You could have gone anywhere, you could have done anything, and you came here and you tested this out and you're trying it out, and I think it's great, and I think it's a tremendous opportunity, and I think it's a great choice. Which is why the only thing I will predict is that 20 years from now, when one of you is up here giving the same presentation, that you'll be saying the same thing. Markets are better than they've ever been, and this is a great industry to be in. So I thank you for coming, and I'll take any questions you have.